Welcome to the Compliance Officer's Playbook podcast. Okay, let's unpack this. Today we are undertaking a critical deep dive into an FCA final notice that is, I think, mandatory reading for anyone operating within the UK financial system.
It really is, especially if you're on the front lines of financial crime prevention.
Exactly. We're looking at the systemic, years-long breakdown that led the Financial Conduct Authority to impose a staggering penalty on one of the UK's cornerstone financial institutions, Nationwide Building Society.
What's truly fascinating here, and I think what gets lost beyond the headlines, is the sheer scale of the institution we're talking about.
Right.
We are discussing the world's largest building society. By 2021, they were serving approximately 18 million UK customers.
18 million.
And commanding a formidable 10% market share of UK current accounts. I mean, when anti-money laundering controls fail at that size, the gaps aren't just minor infractions. They pose a profound and material risk to the integrity of the entire UK financial system.
Precisely. And the outcome of this failure was a financial penalty of just over £44 million.
And that's after the discount.
Right. Let's be clear about that figure. It was issued after Nationwide qualified for the maximum Stage 1 30% settlement discount. The initial penalty was calculated at over £62 million.
So our mission today is really to move past that number and understand the complex machinery that just broke down.
Over a substantial period, too. 4.5 years, spanning from October 2016 all the way to July 2021.
A period where these core vulnerabilities were known and critically tolerated.
That's the key word, tolerated. This isn't just a story about a massive fine. It is a meticulous blueprint for the catastrophic material risks created when an organization fundamentally breaches Principle 3 of the FCA's Principles for Businesses.
Which is the requirement for adequate risk management.
And the related SYSC rules. Indeed. We need to conduct a forensic analysis of the architecture of failure here. We have to see how these foundational issues in customer due diligence, or CDD, created data gaps.
That fed directly into the subsequent inability to run effective, risk-sensitive transaction monitoring, or TM.
And it all happened against the backdrop of a known, escalating, and frankly, inappropriate risk.
The unauthorized use of personal accounts for substantial business activities.
So we're not just analyzing a single mistake, but a compliance debt that just compounded over years. We are going to track how that debt ultimately cost the organization tens of millions and worse, exposed the UK public to major financial crime.
As we'll see with that deeply concerning case study involving COVID-19 related fraud.
Let's start by grounding ourselves in the regulatory foundation. For our listeners who, live this every day, the overarching imperative is constantly drilled in.
It is.
Financial firms must establish controls that minimize the risk of being used for financial crime. Money laundering, terrorist financing. This is the non-negotiable expectation.
That's absolutely right. And the FCA, they're not looking for perfection, but what they demand is adequacy and proportionality. So to achieve this, a firm has to establish and maintain an AML control framework that is robust, risk-based, comprehensive, and crucially, proportionate to the firm's specific nature, scale, and complexity.
For an institution the size of Nationwide, serving millions, that bar is exceptionally high.
It has to be.
And when we talk about this foundational framework, there are, 3 non-negotiable pillars?
Exactly. First, you have customer due diligence, CDD, right at the very start of the relationship. This is about establishing identity, understanding the purpose and intended nature of the business relationship, and determining that initial risk classification.
And if the risks are elevated.
You must apply enhanced due diligence, or EDD, to gather even more granular information. Second, the framework has to be dynamic. This is the requirement for ongoing monitoring.
Which means ensuring that the firm maintains an up-to-date knowledge and understanding of the customer throughout the entire relationship lifecycle.
Right. And the third pillar, which we will see failed spectacularly here, is the transactional aspect. You have to scrutinize transactions to ensure they remain consistent with the firm's understanding of the customer profile and the associated risks.
And if you spot something suspicious.
There is a hard statutory requirement for prompt investigation and the timely submission of a suspicious activity report, a SAR, to the National Crime Agency.
What's important for you, our listeners, to internalize is the specific context of retail banking here. The FCA explicitly acknowledges that retail banking, Current accounts, personal loans, mass market products.
Hmm.
It carries an elevated financial crime risk.
And they're clear about why. It's because of the sheer volume and speed of transactions, the simplicity of digital onboarding, and the necessity for mass market access, which criminals actively exploit.
They use it to integrate illicit funds into the legitimate economy.
Exactly.
And that risk profile changes dramatically when you introduce business activity.
Precisely. The FCA stresses that additional AML steps are specifically required when dealing with SME, small and medium-sized enterprise customers.
Because corporate customers involve inherently greater complexity.
Right. Not just in transaction size and volume, but in the difficulty of identifying beneficial owners and monitoring transactional behavior that reflects diverse business models.
And this expectation becomes absolutely central to Nationwide's failure.
Because they knowingly allowed an SME-level risk to proliferate within a control framework designed only for personal retail risks.
Which sets the stage for the regulatory verdict against Nationwide, centered entirely on Principle 3. The FCA's finding was, well, devastatingly simple.
It was. Nationwide failed to take reasonable care to organize and control its affairs responsibly and effectively, and crucially, failed to maintain adequate risk management systems.
The finding zeroes in on the mechanism of failure. The core breakdown was a deficient AML monitoring system that materially compromised the firm's ability to maintain an up-to-date understanding of its customer base.
And to monitor relationships on a risk-sensitive basis. This was not a minor administrative slip.
No, this was a failure of the risk engine itself.
And it wasn't brief. We were talking about cumulative gaps that persisted over the relevant period, from the 1st of October 2016 to the 1st of July 2021.
4.5 years where this fundamental vulnerability was just baked into the core operating model.
The scope of this failure is difficult to overstate. The FCA concluded that these cumulative systemic gaps led to an unacceptable risk that unusual or criminal activity would remain undetected and unaddressed across the entire personal current account population.
The entire population.
And considering Nationwide's massive market share, this failure meant millions of customers and the entire UK financial system were exposed to preventable money laundering risk.
The FCA also emphasizes the dynamic nature of compliance here. Firms must keep information held on customers up to date. They have to apply CDD measures if they doubt the truth or adequacy of previously obtained data.
And Nationwide's failure here touches every single stage. From the moment the customer was risk-scored at onboarding to the ongoing day-to-day scrutiny of their transactional behavior.
It truly was systemic.
It really was.
Let's dive into the specifics of how the AML architecture failed. The final notice systematically dissects 3 interlocking deficiencies, starting with the most foundational element.
The failure to refresh customer due diligence and conduct robust, dynamic risk assessments.
This is so critical because, as we always say, the quality of your CDD dictates the effectiveness of everything downstream.
Absolutely. From your TM alert thresholds to your SAR decision-making. Starting in 2016, Nationwide's system for individually risk-assessing customers was internally recognized as an unsophisticated interim solution.
Wow. That phrase, coming from an internal assessment, is a huge red flag.
It is.
An unsophisticated interim solution for the risk engine of the world's largest building society. That sounds like a controlled design for a much smaller, less complex institution.
It does. And what it meant for their risk classification was that the vast majority of their 18 million customers were automatically classed as standard risk.
Standard risk by default.
By default, you only moved out of that standard risk bucket if you fell into certain very limited categories, like already being flagged for a financial crime conviction or being a PP.
So if you didn't arrive with a documented history of financial crime, you were low risk, regardless of your actual behavior.
Pretty much. This created a massive, undifferentiated population, allowing high-risk activities to just hide in plain sight.
So the firm knew this model was inadequate. They launched a remediation project, the Retail Risk Profiling Project, or RRP.
Yes, which was intended to automate and improve risk assessment. But this project was plagued by severe delays. The timeline of the RRP project is a classic case study in compliance debt.
How so?
It was conceived to fix this foundational flaw, but wasn't fully operational until early 2019. That's nearly 3 years into the relevant period. But even that deployment was hobbled by poor data quality.
So the data was bad.
Internal audit in May 2019 found controls over RRP data quality required significant improvement.
This highlights that often overlooked challenge of legacy system migration, doesn't it?
Yeah.
Getting clean, reliable data into the new platform. What was the practical consequence of this data discrepancy?
It was severe. It resulted in a staggering 44,957 customer accounts initially not being successfully fed into the central RRP risk assessment tool.
44,000.
Yes, due to discrepancies between the source and target systems. That's tens of thousands of customers whose risk scoring was essentially blind even after the new system was technically operational.
And even when the RRP project began successfully collecting enhanced CDD from July 2019, primarily for new customers.
Or existing customers seeking new products, which was a tiny fraction, maybe 5% of their total base.
That good new data wasn't used effectively for 2 more years.
The data flow was completely broken. The enhanced data collected starting in mid-2019 wasn't integrated into the main RRP system for risk scoring until August 2020.
A full year later.
And it wasn't actually considered for the active customer risk scoring process until April 2021.
Wait, let me just synthesize that for our listeners. If a new high-risk customer signed up in mid-2019 and provided enhanced due diligence data, Nationwide was essentially running their transaction monitoring based on a profile that was 2 years out of date.
They had the information,
But they weren't applying it to their risk score.
Exactly. This profound lag time meant Nationwide was perpetually fighting yesterday's war. And the failure had a direct, demonstrable impact on identifying true risk exposure.
How so?
Well, compliance consultants noted in October 2020 that classifying only 2,000 customers as high risk out of a base of 18 million was exceptionally low compared to industry peers.
That sounds like a massive statistical outlier.
It was. It signaled a fundamental failure of the risk model, and the proof of that failure came post-remediation.
Right.
It really did. Once they corrected the data ingestion and modeling issues, the numbers just exploded. Nationwide ultimately identified over 18,000 customers who were potentially high risk.
18,000.
In addition to those already flagged in existing high-risk categories, that 900% jump in identified high-risk customers from 2,000 to over 18,000 tells you everything you need to know about the lack of confidence they should have had in their system.
Now, let's transition from that initial assessment failure to the process failure. The absence of mechanisms to review that existing customer base, the infamous backbook problem.
This failure just compounded the CDD gaps. I mean, even if the initial risk score had been correct, a relationship changes over time.
Of course, people change jobs, their income changes, their transactional behavior evolves.
And regulatory requirements mandate periodic reviews and event-driven reviews to keep that understanding current. Nationwide's internal policies from late 2018 onwards recognized this.
So they had policies for it. High-risk customers every 2 years, standard risk every 3 or 5, triggered by significant transactions.
But here's the control vacuum. For the majority of the relevant period, and contrary to their own established internal policies, Nationwide had no process whatsoever for undertaking these reviews for a substantial proportion of its customers.
So they had the policy on paper, but they lacked the operational capacity, the system, and the resourcing to actually execute it.
Exactly. This prolonged the risk exposure exponentially. If a customer opened an account in 2010 and didn't take out a new product between 2016 and 2021, their CDD and risk profile essentially remained static, based on information potentially a decade old.
Which compromised their entire ongoing dynamic understanding of risk.
It rendered their entire risk management framework obsolete for millions of customers.
Now let's connect these failures of data and process directly to the final line of defense, the transaction monitoring system. If you don't know who your customer is, you can't establish baseline expectations.
And therefore, you can't spot unusual activity effectively.
You're absolutely right. The TM system was structurally inadequate and ineffective throughout the relevant period. The warning signs were there, even internally.
They were. As early as February 2017, an internal report explicitly noted an FCA final notice against a major bank, highlighting the industry-wide necessity for effective, properly tuned, and auditable TM solutions that integrate CDD data.
Yet, Nationwide failed to heed that warning and lagged severely behind its peers. A 2019 internal roadmap placed their TM maturity at only stage 2 out of 5.
To put that in perspective for you, stage 2 is essentially basic, rules-based monitoring. Their amalgamated peers were already operating at stage 4.
A level of maturity that Nationwide wasn't projected to achieve until the end of the relevant period in 2021.
Right. This technology gap meant their capabilities were fundamentally mismatched with the complexity and scale of their customer base.
What were the functional limitations of being stuck at stage 2?
Well, outside of that small, pre-identified cohort of high-risk customers, the TM rules applied uniformly across the entire 18 million-strong personal account base.
So they weren't risk sensitive.
Not at all. This singular threshold approach meant they couldn't distinguish between a transaction pattern that might be high risk for a student and one that might be high risk for a high net worth individual.
So they either generated massive amounts of false positives,
Or, more dangerously, set the threshold so high to manage the alert volume that they just missed subtle systemic financial crime typologies.
this narrow focus was even criticized by external compliance consultants in 2020. They found the uniform rules inherently limited coverage of potential money laundering risks.
And that leads us to what I believe is the most alarming operational failure identified by the FCA regarding the TM system.
Then what's that?
The sheer delay inherent in the processing, the reliance on the monthly batch process.
Right. Can you explain to our audience why running TM alerts retrospectively on a monthly basis is such a fatal flaw in modern financial crime detection?
It fundamentally undermines the purpose of the control. I mean, in modern money laundering typologies, funds move rapidly.
Yeah.
Internationally, often within days or even hours. When the TM system operates on a monthly batch cycle, it means alerts are only generated based on the previous month's transactional activity. The FCA pointed out the obvious danger.
That illicit funds could be transferred away beyond recovery before the alert is even generated.
Let alone manually reviewed, which could take another 20 working days. This lag time, potentially 6 to 8 weeks between the criminal activity and the response, is just intolerable when dealing with rapid money movement.
So if we synthesize all that, Nationwide was facing a triple threat. One, they had severely deficient 2-year-old CDD data.
2, they had no operational mechanism to refresh that data for the vast majority of customers.
And 3, the only protection layer, the transaction monitoring system, was technologically immature, running retrospective batch alerts with uniform high thresholds, essentially guaranteeing they would be too slow to catch rapid fraud.
It's a perfect storm of failure.
It really is.
Now we must transition from architectural weakness to a failure of strategic and operational governance, the active choice to tolerate risk, and the specific confluence of Nationwide's operating model and these systemic AML deficiencies created a high-risk cohort that became the epicenter of this compliance failure.
The customers using personal accounts for business activity.
Exactly.
So let's set the parameters here. Nationwide, during this period, did not offer formal business current accounts for SMEs.
And they contractually prohibited business use of personal accounts.
Yet the FCA is very clear that SME banking inherently involves higher financial crime risk due to corporate structure, transaction size, and complexity.
This is the operational paradox. Nationwide wanted to operate solely in the retail space, managing what should be a lower, simpler risk profile, but by tolerating business activity.
Even when explicitly prohibited.
They imported the complexities and heightened risks of SME banking into a framework designed exclusively for simple retail use. They just lacked the systems, the CDD data, and the expertise to handle that risk profile.
And this is where the timeline of awareness becomes so damning. This wasn't a hidden flaw discovered by the regulator.
Not at all. Internal audit identified the unauthorized business use issue as a serious risk as early as October 2016. The initial estimate pointed to around 2,700 accounts clearly being used to facilitate business transactions.
And the report explicitly warned management of regulatory censure and exposure to money laundering risk.
So this moves the failure from a technical issue to a governance issue. The internal alarm bells were ringing loudly in 2016. But here's the crucial failure. The strategic decision made in September 2017.
What is that?
Staff recommended deferring proactive mitigation, specifically deferring the closing or investigation of these unauthorized high-risk accounts.
And why? Based on a plan to launch a formal business banking product by April 2020 for migration purposes.
That is a staggering 2.5-year deferral of an identified immediate financial crime risk.
Predicated entirely on a future business strategy, a product that might or might not launch.
I mean, I understand the business rationale. They didn't want to prematurely exit customers they hope to migrate. But how could the compliance team internally justify tolerating a known, escalating financial crime risk for 2.5 years?
How was that approved in the risk committee?
Well, the FCA found this toleration inappropriate because it violated Principle 3. Nationwide's defense was fatally undermined by 3 facts. 1, their personal account controls were not set up for business use.
Right.
2, they lacked a reliable methodology for calculating the true scale of the misuse. And 3, their existing monitoring was already known to be ineffective.
So you cannot tolerate a known risk when you do not possess the necessary controls to manage it.
Precisely. This shows a profound failure of the compliance function's authority to veto business strategy when it contradicts fundamental regulatory obligations.
Let's discuss the practical implications of this toleration, starting with the CDD mismatch.
It was a calibration nightmare. CDD questions were designed to capture personal income, lifestyle, occupation. They completely failed to gather the basic, fundamental information vital for assessing business risk.
Like the nature of the business, expected trading patterns,
Source of funds and wealth for the business, and critically, the beneficial owners of any underlying legal entities.
If you don't collect that data, you can't perform basic checks.
Correct. They couldn't screen effectively against sanctions lists for the business entities being financed. They couldn't identify high-risk industries like money service businesses or MSBs that might be operating under the guise of a simple personal account.
So they were flying blind.
Completely.
Okay.
And the transaction monitoring systems compounded this failure. They just weren't calibrated for business behavior.
That's right. Without necessary expected usage information for a business, high volume or complex business activity risked becoming normalized by the system.
Or it generated confusing false alerts for the already resource-constrained financial crime team. This forced analysts to spend time sifting through irrelevant noise, diverting attention from genuinely suspicious retail activity.
And the internal risks were measurable. An internal risk assessment in February 2018 noted that business use customers produced a significant and disproportionate percentage, 10%, of all internal SARS and TM alerts.
So despite being a minority cohort, they were a massive drain on resources and a primary vector for financial crime risk. They were disproportionately risky, yet the strategic decision was to allow this cohort to continue operating under insufficient controls for another 2 years.
So when the planned business banking product was officially discontinued in April 2020, meaning the 2.5-year gamble failed, that's when impactful remediation finally began.
Yes, they finally had to create a dedicated framework. They developed a model specifically to identify business use, which by mid-2021 generated a figure of 133,200 potential customers needing review.
133,000. Compare that to the initial 2016 estimate of 2,700.
The problem had just exploded in scope during that period of toleration.
That figure shows the real cost of procrastination. And what was the final result of that massive remediation effort?
The firm ultimately identified approximately 16,000 personal current accounts for exit due to unauthorized misuse. That means thousands of customers operating outside the firm's approved risk profile persisted for nearly 4 years under deficient AML scrutiny.
The delay between identifying the risk in 2016 and implementing an effective framework in 2021 is the entire substance of this regulatory breach.
It really is.
Having established the structural failures and the inappropriate risk tolerance, we turn now to Section 4, the story of Customer A. This is the egregious, undeniable evidence of the damage caused, specifically involving the Coronavirus Job Retention Scheme, or JRS, fraud.
Customer A is a stark reminder that regulatory failures have real-world consequences.
This case serves as a perfect microcosm of how every single failure we've discussed just coalesced.
It does. The JRS funds were a temporary UK government scheme designed for employers with UK payroll. So receipt of these payments into a personal current account was immediately deemed a strong indicator of business use, and therefore high risk.
And Nationwide was aware of this specific risk typology early in the pandemic, knowing by May 2020 that about 5,000 personal accounts had received COVID-19 related payments.
Overall, the exposure was significant. Nearly 34,000 JRS payments totaling £64.6 million went into over 5,000 personal accounts at Nationwide.
This cohort should have been subject to immediate, urgent, and enhanced due diligence and monitoring.
It should have been. And Customer A was the most severe individual example. Using a basic retail product, a Flex Basic account Customer A fraudulently claimed and received a staggering £27.36 million in JRS payments between 2020 and 2021.
And critically, $26 million of that amount was received over an astonishingly short period of just 8 days.
And here is the direct, unrecoverable loss linked to the control lag. Over £800,000 of those funds were transferred out before freezing or forfeiture orders could be obtained by HMRC.
That's a clear link between Nationwide's slow, ineffective controls and the successful facilitation of financial crime. Let's track the timeline of missed opportunities, starting right back at the beginning of the relationship.
Okay. Customer A opened their first account in 2014, and already there was a CDD flaw. The address provided was self-evidently not a residential property. It contained the word office.
That should have flagged the potential for business use, yet it was ignored, probably because the default risk was always standard.
Exactly. The low-risk default blinded them to the obvious. Then, as the relationship progressed, the red flags just multiplied. Later applications by customer A were linked to a known fraud network.
On top of that, the JRS payments received eventually exceeded customer A's declared annual income of £80,000 by a massive margin.
The system had enough data points to scream abnormal, but the silos prevented effective synthesis.
And the investigation failure in July 2020 is perhaps the most damning indictment of internal process. An internal SAR was raised specifically about the JRS payments, yet it was assessed not to be suspicious and was therefore closed internally.
That decision was fundamentally flawed. The internal assessment failed to ask the most basic question of all. Why are JRS funds, typically paid to an employer for payroll, going into a personal account?
Which points right back to the unchallenged toleration of unauthorized business use.
Absolutely. Furthermore, the assessment ignored other critical red flags, like large outbound payments being made immediately to a well-known money service business, or MSB.
A classic layer in money laundering.
It is. Had Nationwide properly integrated all the available information, the initial CDD flaw, the fraud network links, the income discrepancy, and the transaction pattern, the likelihood of submitting an external SAR much earlier would have been near certain.
Which could have prevented the bulk of the subsequent fraud.
And even after Nationwide did manage to raise an external SAR in January 2021, based on an internal review, they failed to take immediate, appropriate risk mitigation action.
So despite forming suspicion that customer A was engaged in illegal activities, they didn't restrict the account or immediately exit the relationship.
Right, and the authority specifically pointed out that this inaction allowed customer A to receive the final catastrophic fraudulent deposits that £26 million received over 8 days.
Which happened immediately after the external SAR was filed.
It's a severe governance failure. The system identified the risk, the firm reported the risk, but the firm failed to act on the risk.
To compound the failure of response, in March 2021, a new internal report about customer A was actually closed under an internal 3-month rule designed to reduce duplicative reporting.
And the FCA was unequivocal in its condemnation of that. Internal administrative rules cannot override statutory obligations. The statutory obligation to report new suspicion as soon as is reasonably practicable must prevail.
You can't rely on an arbitrary time limit to ignore new or ongoing suspicious activity.
Especially for a customer already associated with multi-million-pound fraud. The internal procedure actively hampered the timely reporting and investigation required by law.
Finally, let's revisit the transaction monitoring failure in the context of customer A. This Flex Basic account had almost no activity before March 2020. The subsequent activity was profoundly inconsistent with his history and profile.
And the structural limitations of the Stage 2 TM system were perfectly exposed. First, the £1 million plus payments rule was ineffective.
Why?
Because it was only calibrated to monitor high-value, high-speed payment rails like CHAPAS or SWIFT. All the JRS payments were made via BACS, which the existing rule did not monitor. It was a complete blind spot built into the system design.
So the rule intended to catch large suspicious payments missed the largest fraudulent payment stream entirely because it wasn't tuned for the specific payment mechanism being used.
Exactly. And second, the flaw of the monthly batch process was the ultimate enabler of the loss. Alerts for the suspicious £26 million activity were triggered retrospectively at the beginning of the following month.
And by the time those alerts were manually reviewed,
up to 20 working days later, the bulk of the money had already been successfully dispersed. This case demonstrates that retrospective monitoring is fundamentally incompatible with the speed of modern financial crime.
Customer A's story is just a catastrophic illustration of nationwide systemic failures. Onboarding flaws ignored, CDD data never refreshed, high-risk activity tolerated for years, systems not calibrated for the known risks.
And even when suspicion was formalized, the response was delayed or actively undermined by internal procedures.
Now let's bring this full circle by examining how the FCA methodology arrived at that final £44 million penalty figure. For compliance professionals, understanding this calculation is essential.
It is. It helps you grasp the true regulatory cost of failure. Step 1 involves disgorgement, depriving the firm of any direct financial benefit from the breach. Here, the figure was 0.
Right. The FCA didn't identify any direct financial benefit Nationwide gained from the deficient controls.
Step 2 is where the seriousness is quantified. The FCA deemed this a seriousness level 4 breach. For our listeners, level 4 is the second highest level, reserved for severe breaches where a firm's actions caused or risked causing serious financial crime.
And that level carries a starting point of 15% of the firm's relevant revenue. How was that calculated?
The relevant revenue was calculated on the money Nationwide earned from personal current accounts during the 4.5-year relevant period. This amounted to £1.659 billion.
So 15% of that is.
An initial figure of £248.8 million.
That is an immense penalty figure.
It is. The FCA then proceeded with a critical adjustment, reducing this figure to $57.2 million for proportionality, taking into account previous comparable cases against industry peers.
And step 3 involves weighing aggravating and mitigating factors. The FCA applied a significant 10% uplift due to aggravating factors.
And the key factor here wasn't just the failure itself, but the firm's state of awareness. Nationwide was aware, or ought to have been aware, of the importance of robust AML controls.
Because of all the guidance, and more pointedly, the multiple final notices against its peers.
Exactly. Firms like Barclays, Deutsche Bank, Standard Chartered, these notices repeatedly highlighted the necessity of effective CDD refresh and risk-sensitive transaction monitoring.
That is a direct and powerful message to the entire industry. Regulatory precedent applies to everyone. You cannot claim ignorance when your direct competitors have been fined for similar failures.
And this 10% increase brought the pre-discount figure to just under £63 million.
Since this is mandatory reading for compliance officers, let's dedicate some time to those remedial steps. What would a compliance officer expect a transformation program of this magnitude to cover?
This is where the learning becomes actionable for you. An FCTP reacting to this notice would have to focus on 4 immediate priorities. First, system replacement and integration.
Moving from that stage 2, batch-based TM system, to a risk-sensitive, real-time solution.
Exactly. Fully capable of monitoring all major payment rails. Second, a complete backbook remediation. A massive multi-year project to systematically refresh CDD for those 18 million customers.
And addressing the data quality issues that plague the RRP project.
Absolutely. Third, data governance and quality. The FCTP must ensure data collected during EDD is immediately and correctly fed into the RRP risk scoring engine, eliminating that 2-year lag we saw.
Totally.
And perhaps most crucially, a governance and policy overhaul, specifically creating a robust, non-negotiable business use framework and empowering financial crime compliance with the authority to immediately veto or restrict high-risk activity.
It's clear that the final step, the settlement discount, was purely procedural.
Yeah.
Nationwide received the maximum 30% discount for agreeing to resolve the matter early, resulting in that final penalty.
So what does this entire deep dive reveal for the compliance professional tuning in today? This is the ultimate lesson in governance.
This notice reveals a critical, often hidden compliance gap, the failure of prioritization. When strategic corporate decisions like tolerating high risk, prohibited activity while awaiting a new product launch override the fundamental, immediate requirement for effective risk mitigation, the entire integrity framework just collapses.
And that absence of a settled business use framework until 2021 was devastatingly illustrated by customer A,
who operated with impunity because the system was designed to tolerate that exact vulnerability.
This raises an important question that must be asked at every board and risk committee meeting. How do you ensure that when operational or strategic plans encounter a defined financial crime roadblock, the compliance function has the immediate authority and the necessary resource to act now,
rather than tolerating an escalating risk over multiple years?
Right.
The effectiveness of AML controls rests not just on technology, but on the resolve of the institution to act immediately when data quality, system tuning, or operational policy falls short. The delay, the gap between identifying the risk in 2016 and implementing controls in 2021 is the exact definition and measure of this regulatory failure.
And the cost of that delay was tens of millions in fines and, tragically, the facilitation of millions in fraud during a national health crisis. That is the true impact of this notice. Now, as we wrap up this deep dive, remember that the complexity we've discussed is real, but so is the profound importance of the work you do. You are the critical defense layer for the financial system.
Absolutely. Every finding in this notice, every regulatory expectation for CDD refresh, every demand for event-driven reviews, and every instruction for real-time transaction monitoring tuning is another tool in your playbook.
You can use the detailed lessons from large-scale enforcement actions like this one to build an unassailable defense for your own firm.
and ensure that systemic risks like the unauthorized business use we saw here cannot persist or be inappropriately tolerated. We know that being at the forefront of financial crime prevention is challenging. It demands dedication, constant learning, and deep knowledge. That's why we create these premium sessions, to give you the specific, actionable insights you need to be effective, efficient, and most importantly, fully compliant.
Keep asking the tough questions. Keep pushing for those system improvements.
And know that your effort is safeguarding the integrity of the entire financial system. Thank you for tuning in to the Compliance Officer's Playbook podcast. Couldn't do this without you. Catch you in the next episode.